Okay, hello and welcome to episode 11 of the Technical Bootcamp. Today we are talking about sessions and timing. So we are going to discuss the different times of day for optimal trading outcomes, some repeated characteristics that form day to day, and how you can utilize these for better short-term trades. If you're going to be a day trader, this class is going to be exceptionally valuable to you, give you some ideas that you can work with. If you're going to swing trade, you probably won't need it so much, but it's definitely worth a watch anyway. With that said, let's get straight into the class. In the previous episode of the bootcamp, we talked about the fractal nature of the market and how because we're trading pure price action based concepts, the same systems, the same patterns, the same opportunities arise on the 1 minute as they do on the 1 month if you really want to trade either of those extremes. Now, with that in mind, knowing you can trade any time frame, some people I know will want to be day trading. If you don't want to day trade, you want to swing trade, trading say the hourly and up, building your ideas off of daily and 4-hour charts, then this is not really something you need to worry about. But if you plan on doing any form of low time frame trading, then understanding the sessions and the timing, which we're going to talk about today, will be incredibly valuable for your trading. So with that said, let's get into sessions and timing, okay? So there are 3 main trading sessions every day that take place in the market. There's Asia session, London session, and New York session. Each of these different sessions has its own characteristics that becomes useful to trade because if you understand them, you'll be able to take trades at the best time of day and avoid taking trades at bad times of day where the market's not likely to give you what you want to see. So the timing I use for these sessions. Now, this session timing I'm going to give you is from my, almost 10 years of experience now, but it is not the exact session times, okay? This is basically the high volume times for each of the sessions. So we have 1 a.m. till 7 a.m. for the Asia session. We have 8 a.m. to 12 p.m. midday for the London session. And then we have 1 p.m. to 5 p.m. for the New York session. Okay, this is UK time, so it will differentiate between the year when we have BST, British Summer Time, or GMT. So when the clocks change, it will still remain 1 to 7, 8 to 12, 1 to 5, okay? So with that, these are the high volume times, which means realistically the Asia session is actually longer than this, okay? The London session is actually longer than this, running to about 5 p.m. UK time. The New York session extends into the evening. But the high volume time where these characteristics continually repeat and form in the markets are these times exactly, okay? So dial that in. Now, I'm going to show you an indicator you can use in a moment, which will automatically box off the zones, and you just set these times at once, and then you won't have to touch it again. But for now, understanding those are the timings we're working on, and these are the 3 different sessions, let's talk through the characteristics that we see. So the first thing to mention is why sessions work. Now, sessions happen and work, and these characteristics work because of different volume in different places on different assets at different times of day, okay? So Asia session, which is basically through the night time in the UK, is where the Asia Pacific time zone is operating in full. So over in, say, Australia and Japan, it's daytime and people are working. If people are working during this time, that means that the institutions, the banks, the funds, whoever is trading massive sums of capital in these countries is awake, is active, and is working. So through this Asia session, we see major volume for Asia Pacific based currencies like the Australian dollar, the New Zealand dollar, and the Japanese yen. But we see less volume for pairs like the pound, the euro, the Swiss franc, and things based in Europe, the US, or the UK. Because simply the traders who will be trading those assets are currently asleep, or at least not at work, right? So the Asia session, we see biggest volume for AUD, NZD, and JPY. Now in London session, we see a little bit less volume for those because those institutional Asia Pacific based traders have stopped trading. And we see larger volume for GBP, CHF, so the Swiss franc, and then some of the smaller pairs like Swedish kronas and things like that. We see decent volume for those during London because this is the time of day that people in Europe and the UK are actively trading their assets, right? And we have to think not on an individual basis, but the institutions generally working salaried time-blocked days. So then in the New York session, which is basically going to be the high volume time, is pretty much the morning in the US. This is where the US dollar, the Canadian dollar, and obviously US area focus currencies are the most active, all right? So we see good volume for the US dollar, CAD, other things like that during this session, right? So depending on where you are in the world, you need to work out which time of day you would like to trade. Will you be trading through the Asia session, the London session, or the New York session? The least favorable is going to be Asia. If you have to trade through the Asia session, that is fine. I would either focus, number one, on swing trading, where you can completely disregard everything we're talking about in this class, or number two, if you must day trade Asia Pacific focused currencies like the New Zealand dollar, the Australian dollar, and anything that's going to be more active during Asia. If you are based anywhere else in the world, in the Europe, US, Africa, or UK time zones, you can pretty much take your pick as to which one of these you want to trade. For the most part, the volume for the dollar, Canadian dollar, the Australian dollar even does maintain during these sessions when weighted against the US dollar, for example, or the GBP, euro, anything like that. You can trade any of that through both of these sessions, really, because any kind of Europe, US, or UK based currency will see volume through these because of these people transacting with each other, because there is that crossover, where both of these institutional kind of time zones are going to be operating with each other. Okay. So Asia session, basically, if you must trade during that, trade those focus currencies. If you're going to trade through London or New York session, you can trade pretty much anything else. Now, I would recommend just sticking with major pairs, Euro USD, GBP USD, USD CAD, anything like that. There's no real reason to trade anything else if you are able to trade through these time zones. These are going to give you the best opportunity there. All right. So now that we understand that, let's talk about these actual individual characteristics of sessions then. And this is as per a major pair. So for Euro USD, for GBP USD, for USD CAD, things like that, this pattern will repeat across all of those. When you start going into exotics, these characteristics do change a little, and I'm not going to be getting into that at all because it's not something I have or will ever trade. So let's say then we are trading Euro USD or any major pair. During Asia session, we generally are not going to see a lot of movement at all throughout the Asia session, because for those major pairs, those UK, US, and Europe-based currencies, the volume is pretty much dead. The majority of the transacting that takes place will do so through London and New York. Therefore, we create a confined range on Asia, which is basically just consolidation to a degree. Now, we can see upward and down movements. We might see a little bit of chop like this, but usually it's going to be pretty confined, and there's not going to be much directional movement up or down throughout this day. It will generally be pretty sideways and consolidating. Okay. Now into London session, we get a big drive. Most days we're going to have pretty clear directional flow, and you'll see around that 7 to 8 a.m. UK time, we start to rally, okay, or fall, doesn't matter, but we start to see some actual direction stepping into the market, as opposed to the little sideways confined box that we have through the Asia session. And then into New York, we get pretty much the opposite of that. We see another drive most days, but oftentimes it will be a reversal. Now, New York is not always going to be a reversal. Sometimes it will be a consolidation into continuation. But again, basically the point behind the New York characteristic is that we just get another one of these surges of momentum, okay? So what we call these different characteristics, or at least what I call them, is the Asia sweep, the London push, and the New York reversal, okay? Just be aware the New York reversal can also just be a New York push some days as well. So these are the three core characteristics that we see, okay? Now the Asia sweep basically is a liquidity sweep around the Asia range. So as we said, Asia will generally create a confined range where the market pretty much just moves sideways in a small area. And what this range does is create an Asia low and an Asia high. Now the market is then very likely to sweep out one side of the Asia range. So in this example, it could be the low, but generally the way that the market moves through the Asia range in a morning is not the way that the market's going to continue all day. So if you see the market break under the Asia range early in the morning, it's less likely to follow through into more downside and more so likely to actually reverse into upside, which is where we get this sweep characteristic. Because what the market's doing is sweeping out liquidity under that low before it then makes its rally in the opposite direction. Now, this can go the other way as well. If the market sweeps above the Asia high, we can then see, in most cases, or very often enough for it to actually matter, the market will reverse and then take out the Asia low and potentially continue trading in that direction for the day, okay? So the Asia sweep is all about identifying a confined range around the Asia high and Asia low and waiting for one of those levels to be taken out so that we can trade in the opposing direction once the market picks up some steam. The London push is then the next characteristic. This is a big influx of momentum that happens around the open of the high volume timing for London session. The reason this occurs around that 8 a.m. mark is simply because we have obviously institutional traders getting to the desk and beginning transacting with other institutional traders. So as we start to see many transactions taking place, we see more volume, more orders pushed into the market, which creates this directional flow dependent on whether the market is net bullish or net bearish on the asset for that day. So around that 8 a.m. time in the morning is a really, really good place to start positioning trades if you can, because you are likely to catch that nice run of momentum. Then around that midday to 1 p.m. UK time is where the New York session basically has the same thing again. Traders in the US get to their desks, start trading, start transacting. Therefore, we start to see around any point really between midday and 2 p.m. A nice influx of volume from the US, okay, which should continue to drive majors either into a push or reversal, but essentially it's a second surge of momentum. So those are the three characteristics. Now, there are ways that we can take advantage of each of these. They are actually best used with the other concepts, and basically we just look to set our trades up around these times of day so that we can either catch this move, potentially catch the sweep, or catch the reversal. And also, a good note is if you're trading outside of this time, so any time essentially between there all the way back through to the start of Asia the next day, that is not going to be a great time to trade because during these times, we are going to have pretty low volume almost everywhere in the world. So what we generally see outside of the standard session characteristics is more so just the market falling off into some sideways consolidation, which pretty much starts prepping up the Asia range for the next day. Then we'll have the Asia sweep, the London push, the New York reversal, and the cycle repeats, okay? So with that said, we'll jump over to the charts. I'm going to show you the indicator, and I'll show you this in action on charts over the span of a few weeks. Okay, a quick note, quick interruption. The things you're learning here in the bootcamp about technical analysis are necessary. They will help you a lot in your trading. But technical analysis alone is not sufficient to get you to where you want to go. There are other problems, things that you don't see on the charts, that can hold you back for years without you actually diagnosing what the problems are. And these things simply don't show up inside technical analysis. So I've put together a very easy to digest, short 15-minute class, which is going to teach you exactly where it is you're going wrong of the charts and how to diagnose and fix it. The link to that is in the description. It's free, so go check it out after this class. And with that, let's get back to this episode of the bootcamp. Okay, so we're here on the charts. We're going to look at Euro GBP. I'm on the 15-minute time frame because this is around the highest time frame you want to look for this stuff on. And I'm just going to run through a few days of price action to show you this in action. Okay, now I have an indicator which basically puts on the time frames, the sessions. So it overlays this color over each one. Now, green is London, this gray color is New York, and the blue is Asia session. This indicator is called FXN Asian Session Range. You can probably use like any session indicator, but I like the way this one looks. It just uses these shadows. You go to the settings over here and set that up to make sure it doesn't have lines and boxes and ugly things on it. All right. So when you have that on, you want to set that to 1 a.m. to 7 a.m. UK time for Asia, 8 a.m. to midday UK time for London, and then 1 p.m. to 5 p.m. UK time for New York. And then if you run through the charts, this is not perfect, but you will see these repeated characteristics a lot of days, absolutely not every day, and sometimes only one or two of them will play out, but you'll see it's significant enough to actually, utilize an opportunity. So this day here, we have our Asia range, that's our Asia high and our Asia low, okay? Then we see we have the sweep that we talked about, so that's there. And then after the sweep, we even sweep the other side of the range. So one opportunity can be looking to trade the sweeps from one side to the other. Then kind of here, we begin we have sort of two pushes this morning. So there's this rally into the open of London, and then later into London session, we have this rally down. So as we say, it's not always going to be a perfect play out, but it still shows pretty well here how you've got that slower sideways range, then a push into London. And then as we move into New York, this time we kind of reverse here and roll over to the downside. So the initial run in London is bullish. We do then get this reversal into London session, which we won't always get. And then we roll over in New York around the open time between 12 and 2, as we said. 2 p.m. marked the very high essentially of this move. And then we rolled into downside, okay? So we get the sweep, we get the push, and we get the reversal. If we take a look at the next day, again, we have a confined range, low, and then high is just in here. We come in, we sweep the high. So there's the sweep that we talk about. Then we have the London push, and then 12 to 2 around that time, we shift into a reversal through New York session. Okay, so this time, this is pretty much as clean as it gets. You'll see this a lot of days, to be honest, but sometimes we will go and do that kind of rally and then rally in the opposite direction for London. Here's another example of that really. But as we say, what we want to do is look to time trades into the open of London session to catch that initial volume. So we have the Asia high, the Asia low, and in this one, 8 a.m., we open London with a big rally. Then we get a reversal here, and then that reversal kind of slows down in New York. So this one, New York session, bit of a mess, but the London move and the sweep still coming through there at the end of London is showing obviously these two characteristics still playing there. So here we have Asia high, sweep of Asia high here. Then we have the London push. That sweeps the Asia low down here. So you get in the sweeps, so you get in that initial run. And then we have this nice run into the open of New York, okay? So as we say, New York is not always going to be a reversal, but generally the push kind of factor that we get with that big push of volume coming in at the start of each session has been true for pretty much every one of these examples so far, as you can see. You know, we have that push into London, we have a push here into New York. Previous to that, we have a push into the open of London and a push into the open of New York. So whether it reverses or not, you're basically just looking to kind of catch that run of volume when each session opens, okay? And you see that sweep that we talked about? This is why you should generally not trade Asia, because the liquidity around the range will create problems for you, but you can actually utilize this and kind of systemize that into a way you can actually catch trades, okay? Some days, even like 3, 4, 5 times in a row, the characteristics simply will not play out, but they do happen often enough for it to be noted. I mean, I've just showed you a few examples there. Multiple days in a row, that push is kind of the core thing I want to teach you about, and it's happening consistently, the sweeps, the pushes, the reversals. So here we have a messier day. We have the Asia range. We do drive down with direction. So you see that through Asia session, it's directionless, it's sideways, okay? So if you average this out, it would be like that. Well, if you average the London out, obviously it's a clear run down. Same with New York, we don't really have too much of a reversal here, but we have a continuation. So we have the London push, the New York push. Now these are obviously not as clean as the previous, but I'm just putting the point across the sessions create direction, okay? Because that's where we start to see an influx of transactions taking place. So this one, pretty much a total mess, but that is driven by data. Nothing's going to avoid data. So generally in a situation like that, where economic data is kicked in and created a big first straight into the open of the day, that's just not going to be one you want to look through. Then the next day we have that tight confined range, as you see. We sweep beneath. London's a bit slow, but we get that push into New York open. And then here we have again Asia range. We sweep the low of the Asia range. London open comes with a push, and then New York comes with a push as well, okay? So less so reversals in this one, but still the opportunity is there. Again, here we've got the Asia range. We have that London push, and then New York, we reverse into the open between 12 and 2 p.m. So you can see this is a repeated characteristic, okay? It's by no means going to be an everyday thing. It's not a holy grail, but it absolutely is something that can help you to take better day trades consistently, because you understand there's these characteristics the market has a probability of following. And obviously in the markets, everything is a probability. We never know 100% if something is going to play out exactly how we want it to. So if you're playing a game that is based on probabilities anyway, there's no harm in having a approach like this that is baked into the probabilities too. But the main core factor to consider, number one, that Asia sweep can be really valuable if you want to go and try and work that into something that you can use to trade. But number two, the big core thing is really just the time of day that we get the biggest pushes in momentum. Okay, the biggest takeaway from this video is if you're going to day trade, there are specific times of day that you want to be looking to take those trades. And primarily, if you can get the positions on, it's going to be around 8 a.m. UK time into that open of London session. And it's going to be around midday to 2 p.m. London time into that open of New York, okay? Now, when we pass through New York session, we start to flatline on a lot of days. Now, the same can't be said for this day, of course. We did get a nice move down. But taking a look at this day, you see as soon as 5 p.m. hits, there's no direction until London opens the next day. You can see here as well, as soon as 5 p.m. hits, there is no direction through to the open of London the next day, or just before London on this one. Same here. See, we lose direction past about 5 p.m. UK time. Yeah, almost every day. Not every day, but I would say like a clean 80 to 85% of days, the market just loses its direction after this point. And that's simply because this is the point where all transacting is winding down, okay? And what that does is just put us into a directionless flow where really not too many opportunities will be present. If you're holding swing trades, that's fine because you're already in, you don't mind holding it for a while, so it doesn't matter too much. But if you're day trading, A real big, simple tip that you can keep in mind is just get out your trades around 5 p.m. UK time if you're trading these majors, because all that's going to happen most days is the market will move into a chop. It will lose direction, and then you have to hold it overnight. You can't manage it because you're asleep. Kind of end in that situation where the trade may be better just closed. And as well as that, of course, if you reach the low, a good low, let's say on a short position, towards 5 p.m., towards the late end of New York session, you may as well just take it rather than waiting for it to chop and lose its direction, because when the next day begins, the direction can go the other way just as easily. The thing with day trading is you're trading such small time horizons that you're basically in a situation where the market's endlessly reaching back and forth for liquidity. And if your trades are only small, say like a short from here, which obviously when you're trading these lower time frames, this is the kind of trade you're going to be looking at, then there's every possibility that even if on a bigger picture, the market doesn't change, there's a possibility, reasonably high possibility, that the market could reach towards your stop and liquidate you before moving in the overall direction. So as we say, for swing traders, it really doesn't matter too much. But for day trading, it definitely is worth considering. So we see that flat line anyways between 5 p.m. and then the open of London generally. Here's another one, really good one. I haven't actually been looking at the characteristics of the past few, but I'm sure we've passed some. Here we have that confined Asia range. We have the sweep, the London push, and then the New York reversal. Okay, so that's a very clean example. We've been through a few of those, but obviously some days it's going to be completely nothing, kind of like this one. We still get those pushes into the open though, and then other days it'll be a little bit messier, like a push situation. But you get the idea. We're looking for that drive of volume into the open of London and into the open of New York. And we also consider the liquidity that sits around the high and low of Asia. But big takeaway, don't trade past 5 p.m. UK time, especially not executing trades if you are going to day trade, because you run into a situation where, of course, what happens then is you're taking pretty subpar positions that are going to chop you up, all right? So here's another. We have consolidation in the range, sweep the low into the open of London, big rally. Then we flatline into the open of New York, big reversal. The next day, we have the confined consolidation. We sell off into London session with volume, and then we sharply reverse into New York session with volume. So for day trading, this characteristic understanding is very, very valuable. Taking trades here into the open, timing those how you can with your analysis, and then getting out here ahead of this. That happens most days. So that's really how you use these characteristics. What I suggest you do before you start trying to trade them is definitely go through some charts and plot some out, because of course some days are better than others, but these characteristics happen often enough. Here's another one, sweep, push into London. They happen often enough to definitely be valuable to you to understand, okay? There's another, we sweep and then we rally and then we reverse. So yeah, it's something optional. It's not a big core structural concept that you need to understand in order to trade well. But it is definitely something that for day traders, it's worth checking out. Okay, I've tied this into systems multiple times in the past. I primarily swing trade now, to be honest, it suits my life better. But when I was doing day trading primarily, yeah, this was something that I used, was getting those trades with the high volume and then using that liquidity around the Asia range as clear targets for some intraday trades. I actually had a system that was built entirely around the Asia range liquidity, and that is something you could look at doing as well, okay, if you wanted to do that. So yeah, this one wasn't core structural, but it definitely just adds a little bit of value to the way that you trade. Now we are coming close to the end of season 1, but I want to get all these foundational concepts in so you understand what we're looking at, how we trade, and then from there we'll move on to some more advanced stuff. But with that said, anyways, let's close this episode up. Thank you for watching. Hope you found it valuable. It's just a little something to study, and hopefully it turns out to be useful for you in your trading. So head over to the link in the description and watch that trading diagnosis class to learn why you're losing off the charts. And then with that, I'll see you in the next episode.